Good morning, everyone, and welcome back to another session of Market Mondays. We are joined by Kyle Rodda, who is a senior market analyst in Australia, but is now actually in London for a few weeks. So, Kyle, good morning. How does it feel to be on European time?
It feels great to be on European time with everybody else. I'm happy to be here. And it's nice to be back in summery weather, at least for a couple of days in London.
Yeah, so I am Daniela, and of course, we are going to be taking you through the most important events to watch out for in the market this week. As always, before we get into it, a little bit of a risk warning for everyone. Just to be aware that the products that we offer, so CFDs, and for those of you in the UK, also spread bets, are complex instruments and they do carry a high level of risk. So you have to be aware of this when trading them. And also, any information given today is just to be taken as general market commentary and not to be taken as any investment advice. So the agenda for this week, a little bit lighter on the calendar, on the data front, but we will be looking a little bit at equity because they did end the month a little bit on a choppy note. Those last few trading sessions last week, there was a bit of back and forth with some ruling about tariffs and the legitimacy of tariffs, and also some commentary from Trump as well. And there has been quite a lot of traction on something being labeled the taco trade, which essentially means Trump always chickens out. So we can comment a little bit on that and how effectively he has been undoing a lot of the announcements that he's been saying. Other than that, we also have the ECB this week expected to cut rates again. We'll also have inflation for the month of May released on Tuesday. It's expected to drop to 2%. We'll also have the May data for the May jobs data for the US released on Friday, expected to show a minor slowdown in job creation, but all in all, a pretty stable market in the US, and also the announcement of OPEC Plus to increase production by around 400,000 barrels per day in July. So, Kyle, over to you first. Anything to say about the performance of equities towards the end of May? As I was saying, a little bit of a choppy end there on Thursday and Friday last week.
Yeah, it would sort of seem that market participants are more fearful of missing the upside risk than getting caught by the downside risk. We've got the S&P 500 basically at 4% away, less actually. Well, as of Friday, it was about 3.5% from record highs. It looks like it'll probably open a little bit weaker this morning. But nevertheless, Friday's price action was a great example where we had an initial sell-off on those comments from Trump about China not adhering to what has been effectively agreed to, even if I suppose it was just a gentleman's agreement in Geneva. Closing flat for the session after that. After there was, I suppose, some kind of commentary about maybe the two heads of state meeting with one another. But nevertheless, you sort of mentioned this taco trade, which I mean, I suppose is just a kind of less generous way of positioning the kind of Trump put, which is to say that any time that the markets or the economy starts to sputter a little bit, that there may be some level of intervention to strike a deal or step away from the harshest tariffs. So it seems to be kind of supporting market sentiment at the moment and asset prices, that even though the rhetoric has been dialed up again today in the Asian session last night, China slapped back with its basically um, own accusations of things not being sort of adhered to, or the principles of the Geneva meeting weren't sort of adhered to. But the moves are fairly modest and certainly not reflecting a breakdown in relations that could see tariffs go back to the same level that they were before that particular meeting. So again, it suggests that the trend is strong. It suggests that markets are willing to buy into this news, and that any kind of uh, positive developments on trade will be bought into quite aggressively. But at the same time, it sort of creates an asymmetric risk where if things don't go well, and if we do see, even if it's maybe not even with China, obviously we saw that volatility around the threats and then subsequent pause of further tariffs on the EU. If that breaks down, the markets aren't pricing in tariffs at anywhere near Liberation Day levels. So it sort of suggests that there's a lot of optimism and hope being priced into the market.
Yeah, I think the question now goes at which point do we kind of start to price in that risk of things going sideways, or things, sentiment souring. As we've seen this taco trade essentially just gives insight that the fact that Trump or the US administration doesn't really have a very high tolerance for markets and economic pressure. Specifically, we've seen the fixed income market, so bonds and what we call bond vigilantes, really kind of keeping Trump and his administration in check. As soon as we've seen any sort of market reaction in US bonds, we've kind of seen that the Trump administration take a few step backs. We did see 30-year bonds reach around 5%. I believe it was last week. And that was also on the back of that debt structure in the US. There's concerns about the high level of debt, and also Trump effectively dismissing that and just saying, that he's planning to continue spending and there's no real plans to bring down this debt. So investors are to some extent reacting to the latest headlines, whether it's tariffs, whether it's debt structure, whether it's growth scares. We also had the GDP, another reading of the US GDP for the first quarter, slightly better than before, but still contraction in the first quarter. I think it came in at minus 0.2%, up from minus 0.3% in the first preliminary reading. But again, it goes to show that there is some shocks to growth, and this could expect it to continue. And I think markets are reacting to that. But as you were saying, there's an asymmetric risk. And right now, equities seem to be pointing higher, market sentiment seems to be pointing higher. And again, it just goes back to where exactly do we price in that real threat of things going sideways. Ending the month of May, equities, as we can see on the charts here, slightly to the downside. Really that turn on Thursdays, we saw that appeal on that ruling that the Trump's tariffs were unlawful, essentially just giving markets a little bit of a scare there, not really finding any momentum to bounce back on Friday. This morning, looking to open the session to the downside. We've got that sentiment as well elsewhere. Here on Europe, you can see the DAX 40 also showing a little bit of a bearish sentiment to start this morning. The S&P 500 coming off a little bit from those highs earlier on during the Asian session, during Friday's session. So yeah, there is this, again, I guess investors are now looking for what's next, right? What's next, whether it's on the calendar, whether it's on the headlines. And of course, they're going to remain very sensitive to the latest news. But for now, it seems like they do continue to want to keep buying into not only US stocks, but global stocks in general. It's just a case of what's going to be the latest headline to break and potentially threaten any of that bullish momentum.
Yeah, it's a good point you make, Danny, because if you, as you just sort of highlighted on the charts there, you can see that there's that, real loss of momentum in terms of the technicals. And it does sort of make you wonder whether, we're sort of poised for a sort of deeper pullback, on the, if you even just take a look at, the Germany, the DAX or the stock 600, take your pick, but it's that kind of rounding top formation that you can kind of arguably start seeing setting in, which is if you contrast with the S&P 500, you get that kind of long wick. I think it was on Thursday, which sort of saw any kind of move above 5,900 or close to sort of 6,000 kind of being faded, so to speak. So I mean, I thought that we might have sort of seen this situation sort of unfold a few weeks ago, and I was, quite wrong. Mostly, I thought it might have been sort of driven by some of the move at the long end of the yield curve, because that seemed to be sort of maybe putting some pressure on equities a little bit. Maybe again some trade developments. Tech results were pretty solid as well, so maybe that sort of offset things. But it's hard not to sort of see on the charts there that sort of clear sign that momentum is breaking down, and that maybe we don't see a big corrective move to the downside, but some kind of a retracement, just on the basis that we seem to have lost that kind of luster. Seems to be just based on the charts alone, and only the charts. It seems to be possibly imminent.
Yeah, staying on European charts, we can go on to the second point of the agenda, and that is essentially the ECB meeting that we have this week. As I was saying earlier, markets are expecting the ECB to cut rates once again by 25 basis points. I think the current pricing is roughly around 97 or 95%. So a pretty short chance that they are going to cut rates once again. Again, the reasoning for this goes back to the fact that tariffs are expected to hurt growth, and the Eurozone is right now one of the biggest targets alongside China. We've seen kind of the threatening messaging increase in the last 2 or 3 weeks. We did see some positive developments last weekend with those talks with the President von der Leyen, but Trump still seems to be targeting the European Union as one of the big adversaries. So of course that is threatening growth in the Eurozone, and inflation is expected to ease further throughout 2025. So of course that plays into the fact that it allows the central bank to cut rates further. We will have the May preliminary reading on Tuesday. The ECB meeting is on Thursday, so 2 days before we'll have the May reading. It will play to some extent into that decision on Thursday. I wouldn't think it would change anything, but it could potentially skew the commentary, and I think that's where a lot of the sensitivity in market lies. But we are expecting to see that headline CPI drop to 2%, which is the ECB's target. It currently stands at 2.2%, so that would be a positive development. If we were to see that, that would give the bank more reason, or more, I guess, credibility to cut rates further, because we have to remember they have already eased 175 basis points in the last, I think it's 10, 11, or even 12 months now since they started cutting last year. So that is a big chunk of easing that they've done already. They were one of the first central banks to start cutting, and the ECB president Lagarde has said from the beginning they want to be kind of forward-looking and front runners in the fact that they want to start easing the pressure on the economy before the data actually started to show signs of that pressure. So that was definitely well looked at by markets. We saw a lot of positive reaction, specifically in the European stock market throughout the beginning of this year, as they reacted positively to that positioning and stance from the ECB. However, there have been some deviation in the governing council. We have seen some divergence appear. Some members have advocated for caution. We saw this at the previous meeting already in April, signaling that the timing of further rate cuts needs to be debated properly, needs to be adjusted, and on a daily basis, or on a meeting by meeting basis. Specifically, as I said, alluding to the fact that they've already eased so much. Rates do stand at a more comfortable level. They're currently at 2.25%. If they were to be cut this week, they'll be stood at 2%. That is a big difference from other central banks like the Federal Reserve, like the Bank of England. So they already have a positive advantage in that sense. And even though inflation is returning and is returning to 2% and is expected to continue easing this year, there are still threats of a resurgence in inflation on the back of tariffs. Even though it hasn't materialized yet, it could still happen throughout the rest of the year. So that is something to keep in mind. And also, growth has shown some headwinds from the global trade tensions and lagging consumer demand. But all in all, the economy has held up pretty well. The growth in the first quarter was better than expected. So we go back to that very delicate balancing act of, do we focus more on inflation? Do we focus more on growth? How do we keep the stable economy and a stable environment without risking either hyperinflation or risking subdued growth? So it's definitely going to be a balancing act. And I think a lot of the key momentum following this meeting is going to come from the messaging and how Lagarde and the team kind of position themselves going forward. In my point of view, with the language specifically, I think if you get a dovish stance, which includes a cut in June, again, pretty much fully priced in, but also signal of continued easing, I think that would likely boost European equities, the likes of the DAX, the Stock 600. We'd likely see, again, maybe as Kyle, you were mentioning, we've seen that lagging off of the momentum. Maybe this would be the catalyst to try and break some of those recent highs if we were to see that dovish stance where they see a cut and also signaling further rate cuts to come. That would, of course, affect the euro, though. We'd likely see some downside pressure on the euro. Conversely, if the ECB, I wouldn't say if they don't cut rates, because that would be a very big jump from where markets stand now. But let's say they cut in June, but they reinforce this stance, so they want to wait and see, and markets price in a higher chance of a pause in July. I think we do potentially maybe see that weakening in equities deepen a little bit further and see a little bit of a resurgence on the euro. But yeah, quite a pivotal month, I think, this month in terms of determining the trajectory of monetary policy for the remainder of the year for the ECB. Kyle, I don't know if you have anything to say on that.
Yeah, just to say that, the distribution of risks is obviously quite wide. And I mean, I suppose compared to the Fed, the ECB is in a slightly better position just because, its inflation target is closer to being met. The growth conditions are a little bit weaker. So, the focus of the ECB's energies and where it sort of looks to it's basically its reaction function is a little bit clearer. But the problem is, and I think we saw this with the recent Fed decision, and then subsequently the backflip from the Trump administration on certain trade policies, is that you're not just the ECB is not just concerned with obviously the downside risks to growth from tariffs if they get applied, also the highly ambiguous impact that might have on inflation, but you're also dealing with an environment where the tariffs could get removed very, very quickly in the space of a few days, and you've eased policy perhaps either more, or you've guided to the markets to more cuts than will necessarily be eventually required, and you cause a level of volatility, uncertainty in the policy environment as a result going down the line. So effectively, it's just going to be about to what extent the ECB wants to assuage, the market's concerns, or the um, people's concerns, just generally speaking, about the potential deterioration in economic activity from the tariffs, with also just creating as much optionality as possible to ensure that whatever outcome happens to materialize, which is very difficult to predict, that they're on the right side of it, or at least positioned to be able to react accordingly. So, yeah, I mean, the markets I think are priced in largely for a dovish cut. I think, like you said, Danny, you've basically got a cut at this meeting fully priced in, so it's almost certain that they're going to follow through with it, especially with their rhetoric recently. But there's another, I think, two cuts baked in before the end of the year, which, like you said, that would take this easing cycle to well in excess of sort of 200 basis points. Is relatively aggressive. Basically, the ECB has to follow through with that dovishness to be able to see the markets respond in a favorable fashion.
Yeah, and I think there's been a lot of focus on central banks, and the ECB kind of kicks it off this week, and I think maybe not next week, but the one following. We then have the Federal Reserve and the Bank of England, and that does set the tone as well for those meetings, considering markets do believe that they have been lagging. Now, something to watch out for is the US dollar. The US dollar has been seeing again some dovish pressure we saw towards the end of last week here on Thursday. Again, that half a percentage point move to the downside, back below 99 once again. This week, Kyle, we have the jobs data from the US. Kind of what are we expecting from that? How do we expect this to affect the dollar? Again, markets like to focus on the jobs data, but has it been providing much reason to trade it in the last few months?
Yeah, I mean, it would appear that the trend is sort of cyclically and structurally to the downside at the moment for the US dollar. I mean, if we want to start straight with the technicals there, you can see just a kind of couple of levels there you'd be keeping an eye on to see whether the kind of higher low that we've seen is indication that maybe we're starting to see a bottoming process playing out, at least in the short term, or if that basically breaks, we retest that kind of low of mid-April at around sort of 98 or whatever it happens to be. But I think it's sort of telling that you see that like really, really ugly candle, that kind of bearish enveloping candle, uh, basically towards the middle of last week, when we sort of made a bit of a rally towards 100 on the Dixie, but got rejected fairly quickly. That was on the basis of news that tariffs would be, I believe, applied, and then subsequently removed on Europe. That there was very little follow through when it came to that particular move, and that sellers pretty much rejected it fairly quickly, and were far more in control of the price when the narrative kind of shifted again, suggesting that really the dollar remains something that is a kind of fade the rally rather than kind of buy the dip uh, um, dynamic. So I mean, this data is going to be important, I suppose, because there's a lot of optimism that the economy is going to remain fairly resilient, not just through the obviously ambiguity of future tariffs and the uncertainty that has been created just over the last few months, but even despite the tariffs that have already been applied, and as we've spoken about in the past, Danny, are still in the 13, 14, 15% on average, and will probably remain so on the US economy, even under the best case scenario the trade deals get done. So that's going to have some sort of an impact on economic activity. But nevertheless, maybe by virtue of the strength of either of the US economy itself, or it could be that analysts are getting it wrong. You've got the non-farm forecasters predicting the non-farm payrolls number to come in at about 125,000, which is a moderating level of jobs growth, but it's still positive and enough to keep the unemployment rate. It's expected at 4.2%. And it also should be noted too that aside from that, of course, that's going to be the most important figure because it's going to give the Fed a better sense of to what extent it might be able to, or needs to, I should say, ease policy in response to maybe softer economic conditions. But we also get the ISM surveys coming out, the PMIs for manufacturing and services PMIs this week too. And they're also expected to show a slight pickup in economic activity last month, more or less, as some of the uncertainty about trade policy came out of the equation in May. Which again, and what also should be said too, there's a really big significant rebound being sort of implied by the Atlanta Fed GDP nowcast, all sort of indicating that the markets are sort of confident that the US economy is resilient. Again, going back to what we were sort of saying about trade at the start of the discussion here, is that that's all well and good and will support a fairly strong equity market, will support maybe a little bit of a recovery in the US dollar, provided that we see maybe some of these trade war risks diminish. And of course some of this is again very secular in nature because it's a sell-off because of this Sell America trade, or sort of a loss of confidence in US assets. But if all of this sort of comes to pass, that things are much better than expected, it would be obviously quite remarkable, support maybe some of these kind of moves in risk assets to the upside. However, if that proves to be wrong, there's a lot of downside risk still to be priced in, and it does make you wonder whether there's further downside to go for something like the US dollar and even US assets too, which quite interestingly have been sort of positively correlated. Again, going back to that Sell America trade, which is very much about the kind of loss of faith in US assets, generally speaking. But if we get that kind of that sort of fatal conceit that the data is going to remain strong, that trade policy is going to be resolved, and the economy is going to be fine. If that doesn't come to fruition, I don't think that's all been entirely priced in yet. And the dollar, for example, under that sort of set of circumstances, definitely retests the lows, and maybe continues this trend to the downside.
Yeah, I want to just remind our viewers before we go on the last point on the agenda that if you do have any questions or anything you want us to comment on or to kind of give an overview, then do feel free to put it in either in the comment section or the chat bot section. Both work. We will get through the comments or the questions in the next few minutes as we kind of finish off the webinar, because we do have one more point on the agenda, and that is on oil. We've seen a little bit of a move higher today, just around 2.7% currently saying here. Trade has been very sideways, very stagnant over the last few weeks. It seems like today, again, looking to move higher. We have seen some resistance. This is US crude, so WTI. We have seen some resistance around that 61.90, 62 level. And even though we've seen pushes above it, we haven't actually managed to get a daily close above that level in about 2 weeks now, going into 3 weeks. So clearly some resistance there. And we have had some news over the weekend, that news breaking that OPEC has seen another big increase of around 411,000 barrels per day. We already had expectations of that. We've seen minor increases for April, but they have been very substantial increases for May, June, and now July is being confirmed as well. Interestingly enough, this kind of, for me, this is giving the view that producers are trying to make up for the loss in revenue by increasing production. Given that prices have been so subdued and it looks like the trend continues to be poised to the downside, especially as well with Trump lobbying for cheaper energy prices, it kind of seems like producers are saying, okay, well, if price is not giving us the revenue that we want, let's make volume give us that revenue. And we're seeing that increase as well. Talks being said that, key players like Saudi Arabia and Russia are trying to win back market shares either after other smaller allies have increased production, namely things like Iraq and Kazakhstan. So again, putting focus on OPEC plus, dismissing the fact that prices are lower, and once again pushing more production into the market. potentially leading towards oversupply. Kyle, what's your view on this?
Yeah, I mean, obviously we've been fairly range bound. I mean, I think the broader range is somewhere between sort of 55 and 65, and in the last couple of weeks, it's sort of basically been 60 and 63, $64 per barrel on West Texas Intermediate. Clearly the news over the weekend was a little bit better than expected from the perspective that that output hike, or that there won't necessarily be the same sort of degree of output hike in July as previously thought, and there might have been a few trial balloons put out there by OPEC just to sort of see the market's reaction to those output hikes. You outlined, obviously the dynamics really well there in terms of, what's happened on the supply side. It effectively becomes a question of, is demand going to remain strong enough or pick up sufficiently to be able to offset that increase in supply and balance the market? And my sense is that that isn't going to be the case on the basis that economic activity, even under a scenario where trade policy improves a little bit, is still going to moderate for a little while. The markets, oil markets, tend to be sensitive to a little bit more short-term sort of demand drivers, and obviously equity prices, which tend to look out, if not quarters, then certainly years into the future as well to discount the appropriate value of something. So it sort of becomes a question with this extra supply, clearly as well, like you said, with a kind of change in principle from, a producer like Saudi, from, keeping prices stable in between a particular range to regaining market share, maybe trying to appease the United States, and then certainly trying to punish cartel members which haven't been sticking to quotas. There is this kind of persistent downside risk and a fairly significant downside risk at a time where the upside risks, don't seem to be as high. So the daily candle today looks, pretty bullish. We can see on the sort of charts there that maybe it's the 50-day moving average that we've seen the market sort of fade any sort of move from. If it breaks through there, then you go, okay, well, maybe we start to make that play towards 64, 65, and that'll be the, kind of ultimate determinant of whether, again, if we go through 65, whether there might be kind of a reversal going on, which in and of itself could be a signal of, a stronger economic times, ahead, even if it is, again, perhaps a bit of a theme today on sort of hope and misplaced optimism. But again, I suspect that kind of glut that we're likely to see from the supply and demand imbalance will keep that sort of downward pressure on prices. And again, on top of that, that seems to be happening by design and not by accident, which suggests that, interventions will continue to be made to sort of keep prices sort of stably around these levels.
Okay, and just before we kick it off, just some quick commentary on gold. We've seen some demand for this as well. We often comment on gold, Kyle. It's quite a good proxy for market sentiment and I guess kind of the headspace that markets are in. Bit of a tough week for gold last week. Again, we're just seeing equity markets, as we said, and markets in general improve that risk sentiment. These doubts about Trump's authenticity, or I guess leverage in the market, if you may, having been downplayed on the fact that he seems to be undoing a lot of his policies, has led to better risk appetite, and that of course has weighed on gold. I mean, we go over this every week, but we have long-term fundamentals supporting the precious metal, like central bank buying, expected lower rates in the near future, like deviation from US exceptionism or the US dollar, if you may. All of that continue to support gold, and I think that's why we're lacking a significant pullback in gold price, specifically anywhere below that 3,000 levels. You can see we haven't even tried to test it since the beginning of April, when those tariff announcements first came in. So the long-term support is there. We know that. We're not questioning that. It's now a case of we're lacking any short-term appetite to really be a buyer in gold on the back of the fact that markets now question the actual risks to the US economy or to global economies from tariffs, given that they are so easily removed, as evidence has shown in the last few weeks. So again, struggling to move beyond that kind of 3,350. We haven't again seen a clear attempt to break above 3,400 since the beginning of May. We're seeing that reaction to headlines and investors kind of reacting to that in gold and either selling it off when risk sentiment improves or buying into gold when risk sentiment worsens or risk off comes into play. But really, the question is, do we have any short-term drivers left to really push gold higher other than, let's say, things get significantly worse from here?
Yeah, I guess that's where, maybe the data flow becomes interesting this week. And I guess if there's any kind of further deterioration, at least in rhetoric between the US and China on trade, obviously the rally that we've seen so far today is on the basis of that. That'll be the catalyst in the short term required to see the market move higher. I mean, it'll be sort of fascinating because it looks as though, I'm just sort of looking at the charts there with those kind of series of lower highs, but the potential that, if you kind of imagine a bit of a downward sloping trend line there, that, maybe we're sort of breaking out from that today, that, if that is the case, whether that will sort of attract, further buyers into the market. And the question becomes whether, there can be a sort of consolidation above 3,400 to continue this kind of strong uptrend, which, as you noted, sort of lost momentum. You can see that on the RSI, actually. There's a divergence there where the RSI kind of daily RSI dips below that sort of 50 level, which showed that, yeah, really momentum had sort of faded quite considerably, although now it seems to be picking up once again. So, catalysts this week, US and China trade rhetoric, and then, if there's some weaker data that comes through from the United States that kind of increases the prospects of a rate cut coming, going forward, then maybe that's the catalyst. If we see that kind of breakout today, raises some interesting questions from a technical point of view. But yeah, I certainly think that it's a matter of sort of clutching for that next short-term catalyst for traders to find maybe might find an excuse to buy into a strong long-term sort of secular story.
Well, I think that's it for this week, Kyle. Thank you everyone for joining us as always. The webinar has been recorded and it will be posted on our YouTube channel. So if you want to watch it back or send it to anyone, please refer to our channel in the next 2 or 3 hours. The video will be posted up there. And as always, we'll be back here again next week to take you all through the excitement of the week ahead. Kyle, thank you so much for joining.
Thank you so much, Danny.
Bye guys. Have a good week ahead.